Before we kick off the Asian segment, we just wanted to remind you, please like, share, subscribe. Your support is appreciated. So the way we're going to do this segment, we're going to do a quick summary of about 4 different nations. I think right now we're going to do China, India, South Korea, Japan, and then we're going to go deeper into China and then deeper into the others. But we want to provide this kind of high level of what are some of the data sets that came out, what are we going to talk about in a bit more detail throughout. So one of the things that we'll look at with China, retail sales came in a bit better than expected. The expectation was 3.7%, came in at 4.9%. That is, again, a nominal number versus a real number, and we'll talk about those differences as we go through. And it's still a nice bounce, but we have to think about, year to date, they were expected at 4.7%, came in at 14.9%. So you're still seeing this sluggishness. There's a little bit of an acceleration, but now, as we're in November and you have renewed issues of lockdowns and the issue of COVID, you have to think that there was a call to, and it really kicked off in October, to start to store up in case things got worse. And that created a little bit of a panic. Now, some of that fell in October, some of that fell in November, so that also can pad the numbers a touch. And then when you look at industrial production, expected at 3%, came in at 3.5%. You had some shutdowns that were getting reversed. You had some normalization of some activity. But again, it's still a very nominal number when you think about where it sits at this point. And then fixed assets ex-rural continued to weaken. It was expected at 6.2%, came in at 6.1%. Property investment, no surprise there, came in weaker, was expected at 7.8%, came in at 7.2%. And then the foreign direct investment came in softer at 17.8%. And we'll talk about those different things because when you aggregate them all together, you still have a GDP number that is well below what expectations are, not only just out of China, but also estimates from economists in the underlying market. So then when we start looking at India, so industrial production came in below estimates for September, was expected at 4.8, came in at 3.1. That gets better. So September was the kind of the last down month, and then October is going to have a nice bounce. But at the same time, CPI also had a big bounce from expectations were for 4.41% and came in at 4.48%. The problem is there's an acceleration factor that continued through October and then picked up again in November and then wholesale prices just being one piece of that. When you look at wholesale prices coming in 11.14%, was expected, but it actually came in at 12.54%. So again, over 1% higher on wholesale prices, which take time to filter down, which is why that CPI is going to have that push higher into the end of the year. Trade balance was a bit better with exports coming in fairly strong. Imports were a bit lighter than expected, but we'll talk about some of those different pieces. But based on what now we're talking about building some very sensitive equipment from Lockheed in India, you're starting to see some of this tightness or this increased cooperation between India and the U.S. So this is something where we do believe that the import-export side will get better, to the detriment of China, though. And that's going to be one of those key pivots that we've been talking about. Speaking of inflationary pressures, South Korea saw a big step up in import price index. So import price index was last month was at 2.4%, came in at 4.8%. Import price year over year came in at 35.8%. And then export prices were up even more. The index was for year over year came in at 25.3%. Export price index month over month came in at 1.6%. So you're seeing import prices going up, getting passed on, and those are going to be those key pieces. And if you think about who imports stuff from South Korea, from China, from India, it's the U.S. And guess who's going to be eating a lot of these import prices? It's going to be us. So now Japan came in with their GDP numbers. Slightly worse for Q3. The expectation was for negative 0.2, came in at negative 0.8%. Quarter over quarter was expected at negative 0.7, came in at negative 3%. And as we were saying throughout the whole period, we expected Q3 to be much worse than expected. but we do see a fairly strong bounce in Q4. So that's going to, again, the things have really turned around from September. They were getting better, and then they really started to accelerate in October and have continued through November. The increase in automobile production is helping. Obviously prices there have gotten better. So you're starting to see some of that recovery come through, which is where when you look at the trade balance getting a bit better. Unfortunately, in October, expectations for exports were at 10.3%. They came in at 9.4%. Expectations for imports were for 31.8% increase. They came in at 26.7%. So you are seeing some reduction. But again, I wasn't the only person to think Q4 was going to get better. So I think you're just going to see estimates come back down because everybody starts out really excited, and then the real numbers come through and you're like, oh, well, they're not that good. And this is why we've been saying it's that we don't expect, a slowdown. We just expect growth to not be as high as expectations. And that continues to play out here. And then core machinery orders missed in September. But again, they get better as we go through October and into November. Expectations have gotten better. You're looking at investor expectations, consumer expectations. So again, you're having some of these nice bounces off the lows into Q4. Now, as we pivot into China, I think it's important to look at the China credit impulses. They have now fallen to the lowest essentially since 2012. And it's just a matter of we're still not seeing the PBOC do much in terms of re-excite, reinvigorate. So that's keeping things depressed. And then when you look at the Evergrande meltdown on the Hang Seng market offshore China corporate high yield, we're still at, because some are saying, oh well, now it's corrected and can go back up. Well, define correction, because there's always a certain amount of, and especially as someone who has done high yield and distressed debt like myself, certain things cheap gets cheaper until it's bankrupt. And the question is going to be that bankruptcy as to when does the government step in? How does the government step in? And do they step in? And if so, at what capacity? And those are some of those questions, which is why people have still stayed away from some of these new issues. Some of the current issues. And now that there's new issues coming out, it's going to be a good test to how was the demand for this paper in the market. All the while, China construction activity continues to implode, which is, again, something that we want to look at compared to what the official data is versus what the construction activity index is showing. Because when we talk about, and as we showed with China Beige Book data, they saw slowdowns across the board and getting worse from September into October into November, and so far through Q4. So it's going to be a matter of, well, what does that look like going forward? And collapsing construction activity in China points to that further weakness in metal prices. And this is going to be an interesting thing. I have to laugh at this because China Evergrande increased its stake in China Evergrande new energy vehicles to 66.77% from 64.98% on November 9th. It's like, guys, got to get your priorities straight. And now there was another rumor, which somebody flagged to me, that there's rumors that Evergrande is selling apartments that were initially about $125,000 US dollars for $1,600. And to give you an idea of just fire sale prices, trying to raise capital, and again, a lot of that is still not really reflected in the onshore market, even though it should be when you start looking at those WMPs or those wealth management products that continues to increase and tie the consumer to these housing values. And if you're seeing fire sale prices at these levels, that's only going to drag down underlying valuations and the value of those products. So then when you start looking at the China debt to GDP ratio, this gives you an idea of what the expectations are. We have seen some of that debt come down in 2021 so far. So you're seeing some of that cool off. But the level of just debt to GDP is what keeps the PBOC on the sidelines, and their inability or unwillingness to stimulate because, again, there's still so much liquidity, so much debt in the system that they're trying to manage that and pull that out because these companies still have to roll that debt. And we're going to talk about what that roll schedule looks like as we not only go into the end of 2021, but into 2022 and 23. So with that being said, let's go through in a bit more detail on the China stats. So when you look at what the different statistics are, the consensus forecast for retail sales was for 3.8% year over year. Industrial value added output was expected to increase 3%. But let's think about this. The recovery in retail sales was largely a result of higher prices. In real terms, growth slipped from 2.2% year-over-year growth in September to 1.9%. Because remember, China was starting to push down these price increases on the local consumer. So even though retail sales look better on a nominal basis, they're actually worse on a real basis. The stabilization in industrial activity reflects the easing of previous power-related supply constraints more than a recovery in demand. Power supply jumped 11.1% year-over-year last month. The continued fall in the foreign assets still is an outside problem. And then the drop in FAI reflects a huge drop in real estate investment, but there is no sign of Beijing stepping in to make up the difference. Infrastructure investment fell 4.8% year over year, the sixth month on the trot that spending has been down on the previous year. The better than expected numbers are being used to explain why officials haven't been doing much to support the economy. But once you dig just below the surface, reveals that the economy still faces a significant amount of problems. Now, when we start looking at October sales, so China, January, October property sales were up 11.8% year over year. And then the following is the underlying table. So property development investment was up 7.2%, but new property construction was down 7.7%. Home sale value up 12.7%. Home sales in the area down up 7.1%, but domestic loans down 10%. Again, some of these different pieces in terms of where these mixed bags are and the pressure that remains in that system. Now, let's consider, although in real terms, retail sales only rose 1.9% compared to the real industrial output growth of 3.5%. So again, it's a matter of rebalancing in terms of where that was overall. So when you start looking at whether you look at just at October numbers or year-to-date numbers, retail sales, a proxy for consumption, grew faster than industrial production in 2021, but growth in the former still seriously lags growth in the latter in the 2 years. So although the growth data came in above expectations, the stock market was down. Again, looking at the new home price declined by 0.2%. 0.25% after a 0.06% decline in September, and secondhand homes declined by more. Again, that is that downward trajectory that we continue to see and puts pressure on those those wealth management products. So then when you look at where things are at this period in time, and this is getting into some of the politics after the Biden-Xi meeting, which seemed to go according to plan. There wasn't really anything one way or the other that said it was good or bad. They were contentious when they were supposed to. They were friendly when they were supposed to be. But President Xi has essentially solidified his control of the party. And this is only the third time in its 100-year history that the party has passed a resolution on history. The two prior resolutions in 1945 and 1981 served to respectively cement Mao Zedong and Deng Xiaoping authority over the party. Similarly, yesterday's resolution did the same thing. The party is doubling down on the path that Xi has staked out over the past 9 years. And what does that mean? A new economic growth model focused on quality over quantity and making sure the fruits of economic growth are more equitably shared. Again, remember, when we keep talking about the distribution, the common prosperity, these are the things that we continue to see, the common prosperity, again, making that movement continue to shift through the system and a more assertive China on the world stage. That is, again, why we talk about China so much in the first part of our special on geopolitics. And then now when we shift a bit further to the property decline, this is when we start looking at what properties are declining. How are they declining? So real estate investments continue to shift down. Area of houses started is in negative territory, and area of houses completed continues to trend lower. Property and construction downturn deepened in October, with construction starts at a negative 16.8%, crude steel output at a negative 6.3%, property sales negative 5%, and real estate, again, continuing to trend down, still positive, but all being pulled lower, leading to these additional issues. Now, when we look at China new loans cumulative year to date, still up year to date, trending closer to what they're hoping for, but that's cumulative. Aggregate financing continues to remain below 2020 and is tracking closer to what the PBOC is trying to maintain at this point in time and reduce that underlying liquidity or manage the liquidity as nearly 130% of GDP when you look at the total debt outstanding by borrowers. And this is, again, we looked at total, which is closer to almost 300%, depending on what metric you use, can be as high as 325%. But 130% of GDP when you look at the state-owned enterprises. And the state-owned enterprises is where we continue to see some of this strife and is driving some of that. Again, there's always this view that the onshore debt is better and safer than the offshore. And again, we continue to see a lot of cracks on the onshore side. And then the rise of the state-owned enterprise defaults is one of those reasons. And they have continued to accelerate through 2021, putting pressure on what used to be deemed a safe entity. All the while, when you start looking at the economic activity index is now firmly negative. When you look at the indicator, which is pulling down the Lee Ki-Young index, steel rebar prices again coming down, hot rolled coil prices again coming lower, and then when you start looking at iron ore, copper prices, and then the economic surprise index is firmly negative, so the data is surprising to the downside, again putting pressure on some of these underlying commodities, which is where when we start looking at China crude steel output, still down year over year at a negative 21% growth rate. But remember, there was also those issues in terms of some of the slowdowns from the underlying components. Then when we look at China nickel pig iron and aluminum production, again, all falling. China steel production versus iron ore port inventories. When we look at what is in inventory, inventories are going up as production continues to start to flatline, and we think it flatlines here through the end of the year. So now when we start looking at shadow banking, again, speaking to how are they trying to finance themselves, because they do have a lot of debt to try to finance. Financial firms and other enterprises, and then the trust funds are funneled into real estate and cash-strapped China Inc. And you've seen this continuation of shadow banking, the use of those wealth management programs and products, which again just increases the underlying connectivity, if you will, of the consumer to the failure of the real estate market. Then cutting exposures, the property-linked trust products value dropped every quarter since 2019. So again, these are things people are invested in. You have a consumer that is seeing additional pressure, and this is just what we know about, and that's the underlying problem. As the consumer feels worse because they see value coming down, like in the U.S., you've seen your 401k go up. You've seen your house go up. You feel better about spending when you see things rising versus in China where you've seen the opposite. While there's no indication that protests over wealth management products or WMPs have turned violent, even small-scale demonstrations are notable in a country where obviously public dissent isn't very common. In Shenzhen, hundreds of angry investors have stormed the headquarters of both Evergrande and Kaisa. Similar scenes have played out in Shenyang, near the border with North Korea. Regulators have been tightening rules on WMPs and other parts of China's $13 trillion shadow banking system for years, but it was only recently that they moved to cut off one of the last major sources of developer-linked investment products. Earlier this year, authorities banned local over-the-counter exchanges from issuing WMPs with real estate estate as the underlying assets. Again, just another pressure point for the real estate sector. Now, when you start looking at some of the things that are better than expected, when you look at an industrial, China Merchants, Sheiko Industrial, plans to issue 3 billion yuan of medium-term notes in the interbank market, including 1.5 billion yuan of 3-year and 1.5 billion yuan of 5-year notes, and the proceeds will be used to repay maturing bank loans. Last time the company issued medium-term notes was December 1st last year, when the company issued that 1.6 billion yuan notes. So when we start looking at what it is, also on Friday, Bright Real Estate Group announced that it will issue up to 580 million yuan of 3-year notes, the interbank system. So now they're starting to test this market a bit. Is there any type of appetite for some of these issues? But it's to pay off maturing debt. So as they roll at a higher rate, if they can place all of this, that's where you're going to see some of these pressure points. So even though we've seen some of this some of these things getting better on the industrial output side, retail sales, again, nominal, and we went through how things have softened. If you start going into the real side of things, this will become, again, that overarching problem, which is why restrictions on mortgage lending seem to have eased slightly as they're trying to allow some of these companies to roll this debt and to try to tap the markets in some better way. But ghost towns, because of the pre-sale model, China's real estate developers are starting new projects at a much faster pace than they complete them, leaving unfinished homes across China, which is this catch-22 of, well, you need to finish it to get your final payment, but you can't finish it until you have the money to do so, and you're running out of money to do so. And again, you kind of get how this has become such a big and prolific problem as new starts remain elevated and completions come down, which will also create anger for those who bought this and expected to go through. And the WMPs that are supposed to be financed with the rents or condo sales that were supposed to be finalized after completion, again, just increasing the pain and pressure across the system. Now, when you look at the maturity wall, and this is the dollar and yuan notes to come due for Chinese developers. December, we have a significant amount, about 6 billion yuan coming due. In January, we have a lot of dollar bonds outstanding of about 6 billion. And then when you look at January, March, and April of next year are going to be interesting months as things continue to struggle on a global macro backdrop, which would put pressure on the Chinese economy even more so. And then the gap between Chinese manufacturing inputs and output prices reached multi-year highs, but that's something where they're starting to see some of those prices get passed through onto the output side in order to close that gap, which is why the global exposure to Chinese stocks and bonds still exceeded 1 trillion, but we still see some of that foreign investment slowing down as these pressure points continue to rise, especially with what Evergrande is. So we showed you everything for everybody, but now this is just looking at Evergrande with Q1, but realistically 2023 and Q4 of 2022 being an issue, but also the beginning of 2023. So then when you start looking at real estate, 70% of China's household assets, get an idea again of just how connected everybody is in terms of those WMPs and how everything has been passed to the consumer, which is why those land sales as a share of local government revenue becomes a much bigger issue, because the Chinese government is relying on this more and more. So as the local governments have increasingly relied on the property sector, you're seeing government revenue go down, which is why in 2020 and in 2021, they've had to rely more and more on these cash lines or these transfer lines coming from the PBOC directly into not only just the provincial level, but also the local government level. Now, when you start looking at China's new home prices fell again in October after the first drop in 6 months, which is just continuing on. China's home slump deepened in October as declines in prices and sales and property investments widened. New home prices in 20 cities slid 0.25% or 25 basis points last month from September. At least 21 cities, mostly smaller and with weaker economies, just lost that. Weaker economies have imposed floors on the lowest price developers can sell to limit the market slump there. Again, just showing you the pain that a lot of these guys are in. Now, when we start looking at the inflation overall, Japan's PPI has now broken above the 2008 levels. And even though inflation remains low internally, you're seeing that the hard pivot off of this negative PPI survey was at 6.9%, came in at 8%, and you get this reacceleration, which is why even Japan is now seeing inflationary pressures when we go back through the supply chain. And as this pulls forward, we're going to see more of this price hit all places, especially the U.S. As private consumption, government consumption, you're seeing a fairly strong shift and the expectations, which is why we see some of this growth as we head into the end of the year. Now, when we look at Japan, you can see GDP coming in below estimates and just where it is. So even though we're going to see growth in Q4, we're still not at pre-COVID levels, far from it. And private consumption still remains the massive overhang. And again, private consumption was always an issue in Japan and a lot of Asian nations just on a cultural level. So this is just a much bigger, an even bigger issue on top of that. Now, South Korean export prices index, just to give you an idea of how that surge really looks. So you have Japan PPI exploding. You have export prices index, just pushing up to 2008 levels out of South Korea. Again, the U.S. imports all of this, which is why we don't see deflation, but that stagflation when we go back through that time period. And then when you start looking at the price diffusion index, items with CPI above 2% is now increasing at 42%, and the BOK policy rate, we expect it to see another rate increase in order to try to stave off some of this inflation. All the while, the India Index of Industrial Production has dipped below 2018, but still remains robust versus 2020. India CPI year over year, still at the low end, but again, there's a lot of pressure points that are sending that higher, which we'll discuss now. So the base effects that have contributed to lower inflation until now are set to turn less favorable in the months ahead. So when you start looking at where things are, since May was largely driven by a tumble in a set of food items where price changes tend to be short-lived, and they were already showing signs of turning higher since October and have only accelerated in November. So the expectation is that the RBI's 2 to 6% target band by the second, inflation will go above that 6% level as we continue to see that drive higher, which if you look at PPI in China, in Japan, in South Korea, in the US, in Germany, again, it's just everywhere. And this is all fed through and fed down, which is why we're going to continue to see that. And the reduction of roughly 5% in gasoline prices and 10% decline in diesel, reflecting the government's decision in November to reverse last year's fuel tax hikes and additional price cuts by state governments, should counter some of the surge in prices in October and mitigate further upside risk to inflation on the energy side. But as we've talked extensively about food, that's not going to slow down anytime soon. So then when you look at industrial's output drops in September, but gets better in October. So industrial growth tumbled to 3.1% year on year in September from 12% in August. The outcome is worse than the consensus of 4.8%, and the breakdown showed widespread weakness across all sectors, including mining, manufacturing. The sharp decline in manufacturing growth to 2.7% year on year in September from 9.9% in August, most likely reflected a slowdown in external demand and bottlenecks in global supply chain. And obviously you also had your electricity issues, your shortfalls. So there are some of those uplifts that we expect. But again, the India wholesale price index continued to go up, putting that pressure on where we see inflation and how we do believe it will cross the RBI's the bellwether. Higher food, fuel lifts headline inflation. And as we've been saying, the food and beverage continue to go up, which is why they've been targeting so aggressively fats and oils, because oils have been the biggest driver so far in October and only increased in November. And vegetables have also caught up and seen an increase. which is why when you look at core inflation shows that slight increase, that's when you start looking at the weightings, and we expect to see this acceleration again across all fronts, but more importantly across food and then the pass-through of wholesale prices, PPI to CPI, and the underlying not only export market but also internal market. So I know we covered a lot. There was a lot of things to talk about given some of the data sets. If you have any questions, please reach out. We love to talk on either Twitter or in the comments section. And again, we appreciate your feedback and support. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.